So good afternoon, everyone, and welcome to this open hearing. Thank you for the extensive participation for today's event. We have 500 plus registration, so we are very pleased for your engagement. Let me start with a quick round of introductions for the ESMA moderator for today's session, as you will be with us for the next 3 hours. I'm Giulia Ferraris, a senior policy officer at ESMA. I started my career in the private sector in London and then have worked at ESMA for 13 years now, working on market abuse and data reporting. So I can say that I had my fair share of sectorial reporting rules by now, starting with EMIR, then MIFIR, and now MiCA. And in my current role, I lead the work on the market abuse surveillance under MiCA and the work on the comprehensive review of transaction reporting, which is the topic of today's open hearing. And also is importantly one of ESMA flagship project on simplification and burden reduction. And then together with the other ESMA colleagues connected today, you will see them popping up as we discuss. We all work in the Data Intelligence and Technology Department at ESMA. This is the department responsible for the entire life cycle of the dataset under the authority responsibility. It goes from the definition of the data requirements for reporting to the development of the system to ingest and process the data, and the final use of this data for the purpose of data quality, data monitoring, and risk. And with that, I also pass the floor to the other moderator for today's session and also the pillar of this initiative, my colleague Javier, please.
Thank you very much, Julia. My name is Javier Nieto Jacome. I work in the same unit as Julia. I joined ESMA more than 5 years ago, mainly on transaction reporting matters for EMIR and MIFIR. Before that, I worked more than 10 years in the private sector, in the banking industry, also dealing with transaction reporting and production reporting projects. And I have been part of the team in leading the work on this holistic review from the beginning, and today I will be supporting Julia during the presentation.
Thank you, Javier. Before we start with the content, just some housekeeping matters. So this event is being recorded. We will make the recording available after. We also welcome you to raise the question as we proceed in the presentation, and you can use the chat for this purpose. Given that we have a high number of participants, we expect a high number of interventions, so we will try to address them, the question as we progress in the presentation. But at the same time, we will also be filtering the question to ensure that we have a fair and balanced representation of all the stakeholders. So when you are submitting a question, you should clarify also which organization you represent, and also be mindful not to make multiple interventions from the same organization. You can also use the camera to ask a question. It would be better to keep the camera off during the presentation and during the conversation, but if you want to raise a question orally, you can show yourself, and we can then take the question at the end of each section of the presentation that I'm about to give you. So with that, we can start with the presentation for today. We have structured it into 4 parts. First, to set the scene, give you an overview of the background of this initiative, the objectives, and the key goals for today. Then I will move into the discussion of the findings of the call for evidence, so the feedback that we have received, which we have also incorporated in the interim report that was published at the beginning of this month. I will then move to the cost-benefit results. So as you know, and it was also announced in the interim report, we also launched an independent cost-benefit analysis that was run by Deloitte. So we have now some preliminary results that we wanted to already share at this stage. And finally, I conclude with the timeline and the next steps. In terms of the objective for today, so the first and foremost is to present the interim report. So you have seen the publication. It has been already a few weeks, so hopefully you will have time to familiarize with the content. And the second point is that because we have these preliminary results already available, we want to take this opportunity to give you a preview of what we have seen, and also to give some visibility on the outcome of a recent workshop that we had earlier this week with the respondents of the cost-benefit surveys. Importantly, also, what we want to emphasize is that what we discussed today is only the very first step of a much longer process. So at this stage, what we focus is on the framing and testing of the key policy changes that we need to introduce in the level 1 framework to be then able to proceed with detailed implementation topics. So this is something that we need to tackle at first, and we need to do it fast to develop concrete proposal on what are the fundamental changes to the level 1. And this has to be developed to be relevant for the ongoing legislative reform, which are taking place in the course of this year, in fact. So there is a sense of urgency to getting this first step finalized within the next month, because the political climate has shifted. It's clear that reporting burden reduction is ranking high in the co-legislator agenda, and we don't want to miss this opportunity to make this recommendation. It also means that we cannot get lost into detail at this stage. Doesn't mean that we are disregarding them. We need to set the direction of travel now and agree on the principle-based changes that should drive the simplification exercise. We are, of course, open to further discuss with the industry the details of the implementation, and we are fully committed to set up a more inclusive governance model also in close coordination with the industry for the implementation phase. But this is all provided, of course, that we can get the green light from Brussels to proceed with the level 1 changes that we want to recommend. So let's move to the background. So why are we doing this and what is driving us? First and foremost, this is not a regular consultation. So we're not looking at a specific regime under a specific framework. We are looking beyond the incremental changes that are needed in a specific legislation. What we want to do is to have a cross-sectorial approach to the simplification and ideally tackle multiple frameworks with the same initiative. And this idea is not new. It actually stems from the ESMA data strategy, which took on board the conclusion of the European Commission fitness check on regulatory reporting. And as a result of these assessments, it also set a clear mandate for ESMA in the context of the MiFIR review. And this mandate asks us to assess the feasibility of more integration in transaction reporting and the streamlining of data flow by 2028. What we have decided last year was to advance this mandate to now, and we did that in close coordination with the Commission. And the reason for that are two. First of all, we want to respond to the burden reduction agenda and the call that are coming from the regulatory community and also from the market to simplify. And second, we were facing, again, a new sectorial review. One of the key reporting frameworks covered by this call for evidence is MiFIR reporting. And as you know, there was already a review ongoing that we launched last year. And as a result of this exercise, we decided not to introduce any changes to the MiFIR reporting regime, precisely to avoid this incremental change now, and then move to a more comprehensive and coherent one later on. So this is the approach, and this is the reason why we decided to start this work stream. We also wanted to combine this regulatory exercise with a more comprehensive cost-benefit analysis, given that we are talking about burden reduction simplification. The idea is to assess cost drivers and key benefits stemming from the policy choices. And so we launched two cost-benefit analyses in the context of this work. One is a cost-benefit that was run with industry participants, and it was given to an external consultant to perform. So it was Deloitte that provided the analysis to us, and we will discuss the preliminary findings today. We also launched a second one, and this was entirely managed by ESMA staff, and it was focused on the cost for authorities to have a balanced assessment also of what could be the impact on the supervisors on these measures. So moving on the industry engagement, yes. So basically, between June and September of last year, we ran the call for evidence. And then in December, we already held a data day, a broader event that was focused on the key topic of burden reduction. So the call for evidence was a key underlying theme also of this event. We received 108 submissions to the call for evidence, and they came across all industry sectors. So as you can see in the slide, particularly strong the sole side participation. But we also had meaningful input from public authorities and the pan-European associations, which also delivered quite detailed cost surveys. And this strong participation is confirmed. It is confirmed that at the data day that we had in December last year, where we had 1,000 participants registered and then over 400 connected. And we are pleased also to see that this participation continues today with you present at the open hearing, and seeing the number now, we have 332 connected at this moment. So very pleased to see that you are engaged and you want to discuss. So maybe we take a little break. We are now at the end of the first part of this presentation. So let's see in the chat if there are already some reactions from anyone. The presentation, yes, we will make available the presentation, and we will also, as I mentioned, make available the recordings of this event. I don't see any more questions or reactions so far. So let's move into the meat of this event, the findings of the call for evidence and what we have included in our interim report. But before turning into the actual finding, just to recall all the simplification measures that we are assessing, they are anchored in a common set of principles that we have clearly defined in the call for evidence. And I wanted to spend a bit more time on this, especially on the first two. So first of all, the principle of preserving information scope. What does it mean? Simplification is not an end in itself. What we want to achieve is the broader objectives of making European market attractive and competitive. And what it is clear is that we cannot achieve this objective by completely disregarding also other objectives that are the protection of foreign investors, the financial stability, and market integrity. So we need to find the right balance between the supervisory needs of the authority and the compliance costs that are passed on to the industry. That also translates into this principle of preserving the information value. And this means that we want to make sure that any simplification measure change into the reporting structures and templates would not mean that the supervisor will lose information that is meaningful for their data supervision. But this means that we need to look at the concept of meaningful information. So meaningful information means that the data needs should be assessed and addressed based on the actual use of the data. So the data that is costly to produce and is not used because of our findings clearly is a clear candidate that should of simplification, for example. And this can be exemplified in the context of the option 1A instrument delineation that we had in our call for evidence, where the proposal was to do the reporting of OTC derivatives only under EMIR and the ETDs only under MiFIR. Clearly, when you move all the reporting of OTC under EMIR, that also means that the template under EMIR will need to be adapted to contain all the information that is necessary for the supervisor to perform the market abuse monitoring. And this does not mean the full MiFIR template, but for example, at least the granular information about client and the person making the investment decision is something that is crucial for performing market abuse monitoring. So it cannot be disregarded, and it would require then a change in the template. This is one of the key examples, but there are many related to this principle. The second principle that I wanted to emphasize is the principle of reducing the overlap and the duplications. So here, this is something that clearly should drive the exercise. It has been confirmed in the responses to the call for evidence. It was clear already from the European Commission fitness check on regulatory reporting. And the idea is that this principle apply both to the reporting templates and the reporting channels. So we need to see how to be efficient and how to make sure that there are no duplication and overlaps. What is important is also to stress that the key problem of this, of the current setup that we have, is that we have a siloed approach to rulemaking, whereby the reporting rules that we are defining, and we have been defining for the past years, they are rooted in one specific regime, and they've been designed having in mind a specific supervisory purpose. So the idea of moving beyond the sectorial approach will enable us to rationalize a bit more the data reporting to ensure that where it's feasible, there might be multiple supervisory needs that can be addressed by one regime in a more coherent manner. The third and the fourth principle in these slides, they are quite self-explanatory. So the first one is pursue global alignment, and the second one, balance the costs and the benefits. Here it's we need to be mindful, of course, of all the international developments and the global standards that have been set, especially when it comes to derivative reporting. This is quite important. And it is also critical to avoid fragmentation to the extent that is feasible for the cross-border firms. That is, of course, taking together all the other principles and making sure that they work comprehensively. So when we take all these principles together, they provide a clear compass for this exercise. So this is what has been driving us and what led to what we have included also in the interim report. And we will be referring back to this principle also as we proceed in this presentation and in the discussion. Okay, let's move then to a more detailed description of what was the feedback that we received to the call for evidence. As mentioned, we had broad participation from all type of stakeholders and industry sector affected. So the expectation initially was that it was not a given that we would have a convergence of view. Notably, when we do this broad consultation, it's very easy to find a lot of area of tensions and divergence of view. But we can say that, in fact, on the main principle, there is quite a consensus and an agreement, in particular on the necessity of reform, but also on some of the points that are outlined in this slide. So first of all, the need to revise dual-sided reporting. This is something that was across the board recognized as a key cost driver and something that should be assessed. And then in terms of the option presented in the call for evidence, we have identified that in the long term, the stakeholders have a preference for the option 2A, the report once model, as this would be the only option that addresses also the common concern and also cost driver of the sectorial approach to rulemaking. So if you only tackle and provide intermediate relief on specific sectoral legislation, but you don't tackle this major concern across the board that the rule remains sectorial, you might have intermediate relief, but then you will never solve the problem of then this rule being changed in an unsynchronized manner and not in a comprehensive and predictable way. So this is something that we took very seriously, also in our cost-benefit analysis. But at the same time, it should also be mentioned that in the near term, there is a majority that prefers to implement intermediate steps and provide as fast as possible relief to the industry. This is because the long-term solution is perceived as quite comprehensive and might take some time to implement. And we cannot, in the meantime, completely forget about the need for burden reduction and simplification. And we should also work on finding those intermediate relief, the so-called low-hanging fruit, on the way to the work towards the target solution. So on this concept of low-hanging fruit, we had some divergence of view among stakeholders. It must be said that nothing was completely consensual, in particular when it comes to the interpretation of the option 1A on the delineation of the reporting by instrument. So the option that was prescribing ETDs in MIFIR and OTC in EMIR. Here we had different perception depending on the type of stakeholders, with the major pan-European association from the sell side perceiving it as something quite a good candidate for a low-hanging fruit to provide early relief with no significant changes, while the national associations, the regional association, and also certain participants from the non-financial sector were much more cautious and expressed concern with this option, as it could potentially bring significant changes to preserve the information scope. And then these changes will be then on top, come on top of what will come with the target solution. So on this notion, there was a bit of a divergence that we had to manage. And this is also reflected in the scope of the cost-benefit analysis and what we have decided to do when it comes to the intermediate steps to be assessed, and the variant of the option 1A that should be subject to further cost analysis. We have, before we jump into the cost-benefit, we just wanted to have a bit more details on some of the key topics emerging from the feedback. So notably the dual-sided reporting. This is definitely something where we have strong consensus. And the key takeaway for us, it also comes from the workshop that we recently had, is that the costs stemming from these obligations, they arise when counterparties are notified by trade repositories of the reconciliation breaks. So these trigger a constant need to communicate among counterparties on each data points that is subject to the reconciliation requirements, and this is perceived as very burdensome, and also it's something that is reflected in the costs that were reported to us for the cost benefit. At the same time, we also received feedback from the authorities asking us to be mindful in maintaining some level of communication among counterparties. And this is because if there is no communication and all is left to one side, then there is no longer any data quality control in place. So the key here is to find the right balance between these needs. And in the interim report, we already indicated that the existing framework for mandatory delegated reporting that was introduced under EMIR REFIT could be a possible measure that would offer something that has already been tested by the market in the context of EMIR Refit. At the same time, it's something that would allow the centralization of the reporting to only one side of the trade, and addressing the main cost driver that was identified, which is the need to react to the TR reconciliation break. That is because in the context of the mandatory delegated reporting, TR reconciliation becomes irrelevant, and so you will no longer apply. And in this way, you would address this concern. At the same time, this measure would also preserve data quality because it maintains some level of communication between the counterparty. So we'll tell you more about this later in the presentation when we go through the also feedback that we received as part of the cost benefit. But the key challenge that we have identified here is the definition of the reporting responsibility. So here, of course, if you change the model and no longer two counterparty reports, you need to set clear rules as to who has the responsibility in this model. And we understand on a principle basis, we have a clear principle, which is the rule based on the most sophisticated counterparty. So that is something that in principle can be agreeable. But then this concept is quite clear for some trades between financial and non-financial, not so much for other type of trades where involving, for example, two financials or two non-financials. In these cases, there is no one size fits all for all the scenarios. So it's very difficult to have a definition of the scope in level 1 for these other trades. I think we can move to the next slide. Yes. So here, just to conclude on this part of the presentation, the key takeaways from the feedback: we see broad agreement on the need for the reform, integrated reporting under the report once principle. So having this three framework, EMIR, MIFIR, SFTR under the same reporting regime, is something that is welcomed as a long-term solution. At the same time, this support also comes with the recognition that there is a need for further cost-benefit analysis, and also that moving to the target solution requires some investment. So we need to assess whether such investments can be recuperated and can turn into saving. And also they should turn into saving reasonably fast, otherwise the whole benefit is lost. In the near term as well, many stakeholders are asking for immediate or early relief. So ignoring this would be really ignoring a part of the responses. But at the same time, we also need to be mindful that this intermediate relief, these intermediate measures should be compatible with the target solution, because otherwise we would introduce something that then would be reversed when we get to the target solution and would not really achieve the benefit that initially we thought would achieve. So this is a delicate balance that we will need to continue discussing, also in the context of future industry conversation and in the implementation phase. And to conclude, for the implementation phase, what was clear as well is that we need to establish a clear roadmap for the reform. So we need to have predictable steps and implementation milestones, and also explore potentially a new governance model so that we have a more intense interaction with the industry on these more technical topics that we will need to tackle as we go, we progress with the implementation. So all this, of course, is subject to the first step that I mentioned at the very beginning of the presentation. So the level 1 changes being included in the current legislative cycle and give us the green light for this initiative to start, of course. Okay, so with that, we are now reaching the end of the second part of the presentation. And I saw that there were some questions in the chat. I'm not sure if we were able to filter them. Okay, so let's take them as they go. The first one was from Jonathan. So level 1 change proposals were referenced in part 1. Are you able to provide a little more detail of the time frame for this initiative? Is this work to be implemented by the end of the current term of the EU Parliament?
We responded already to this one, I think.
Okay, sorry.
Skip it.
All right. Okay. So which one are we missing?
No.
Okay. So the next one, a comment for the first principle. In the context of simplification, competitiveness, and the objective of reducing 25% further reduction, data feeds with limited added value should be removed. The justification is simplification itself and the need to effectively reduce operational and compliance costs. The wording, reassess data elements with limited added value, only when justified should be amended accordingly. So this is more like okay, I have suggestion for how to amend our principle on the information value. It is very much in this spirit already what we had in the call for evidence, and we have slightly changed, amended a bit the title of the principle in our interim report. But we can definitely take on board this suggestion and see what we can further clarify in the final report. Yes. Again, on preserving information value, we have Quentin from BNP. Should we not add for the purpose of specific regulation, market abuse control, supervision, and not for other purposes, statistics, research?
On this,
Please go ahead.
On this, I think we limited the use of the data to specific purposes, as we currently have now, probably leads to increased ad hoc request of data, and this finally turns into increase of the cost. So here the aim is to reuse the data as much as possible and use it for different purposes, and that's why we frame the principle the way it is in the presentation.
Yeah, I guess like for statistics, it depends on the type of statistics and also the supervisory need, but I guess the general mandate of the supervisors are the one that should prevail. Okay, then another one from Hubert, I think it's from Deutsche Börse. Okay, what do you define as expanded delegated reporting? Does that mean that the more sophisticated counterparty has to report the transaction twice for buyer and seller? It's just that basically the value, as I said, like under the delegated reporting model, maybe having
essentially what we are referring here is trying to understand the possibility of expanding the current sectors impacted by the current provisions we have in both EMIR and SFTR. EMIR is Article 9.1, where we have the possibility for non-financial corporates under a specific threshold to fully delegate the reporting to the financial entity when engaging with financial entities. We are assessing whether it will be possible to expand this model for other sectors beyond the small non-financial corporates. And this is what we mean by expanding the delegation of reporting or the current business cases for delegation of reporting. We have similar provisions in Article 4 of SFTR, and equivalently, the plan will be essentially the same to understand also if under SFTR we can expand the number of scenarios under which reporting entities can delegate the reporting to the counterpart. This is what we mean by expansion of the delegation of reporting.
Thank you, Javi. Yeah, so I reading through the chat, then we have we have a few questions on the delegated reporting expansion. I suggest that we continue with the presentation on those ones because I will address them later. Once we have also discussed the cost benefit analysis and the results of the workshop. But then, okay, yes, they are all from delegation. Oh, yes, okay. Yes, so there is a question as to whether a single-sided reporting is something that we are ready to consider, despite the authorities confirming a negative impact on data quality. So, as I said at the beginning, also when it comes to when I was explaining the principle driving this reform, we need to find a good balance between the compliance cost and the need for the authorities to continue to perform their supervisory duties. So the data quality is a key component and key enabler for the authorities to perform their duties. That means does not mean that there is only one way to achieve data quality. So it might be that we might want to revise the way TR reconciliations are performed. Also, in the context of an expanded delegation, the TR reconciliation will no longer apply because they're not relevant. But at the same time, the question will be, we need to see which level of communication between the two parties is acceptable and must be maintained to ensure data quality. This is not something in our view should be completely addressed in the final report, as the final report is only focusing on the level 1 changes. It's something we continue discussing also with the industry, with the technical expert, to see what is an acceptable level of communication. Clearly cannot result in replacing or being equivalent to the level of interaction that is required under the TR reconciliation. Otherwise, we might as well maintain them. But it definitely is something that we need to further discuss and tackle in the implementation phase. Okay, so I think the rest, yes, there were other questions on delegated reporting. As I said, we have another part of the presentation where we discuss this more in detail, also based on the result of the workshop. So if you allow me, I will move on. And I will start with the less public part of this presentation, because you haven't seen it yet as part of our interim report. So this part of the presentation is aimed at giving you a preview of the results that we have received as part of the Deloitte cost-benefit analysis, and also the discussion we had in the context of this analysis with the respondents to the cost-benefit. So we had a workshop on that earlier this week. So the feedback to the call for evidence, what I just presented, is something that determined also the approach that we took to the cost-benefit analysis that was conducted by Deloitte. In particular, what we wanted to focus on were the two options which received most support. So we did not assess the more comprehensive option of performing integrated reporting beyond MIFIR, EMIR, and SFTR, as that was already clear from the feedback we received from the cost-benefit. Was conceived as too ambitious. At the same time, we also did not perform any cost-benefit on the option 1B, so the one that was proposing a delineation of reporting based on the type of event, as it was already clearly discarded by the qualitative feedback that we received in the cost-benefit, in the call for evidence. Apologies. So the cost-benefit analysis then focused on, first of all, the few variants of option 1A, which was welcomed as an intermediate step towards the target solution, and most importantly, on the benefit of the target solution in the long term. So the benefit of the option 2A in the long term, assuming that this target option would still cover and contain the elements that are part of the option 1A. So the variants of option 1A were designed because of this divergence of views among stakeholders that I reported in the previous slides on what basically what is an intermediate step. So the idea then was to assess option 1A as presented in the call for evidence. So with the schema changes to ensure that the NCAs can continue monitoring market abuse with EMIR data, and also with schema changes to ensure that the central banks and the risk supervisor can continue monitor systemic risks. But then we added also 2 variants to this option to make sure that it can be framed also as a realistic intermediate step that does not introduce major changes to reporting templates and schemas, and at the same time delivers some immediate burden reduction. So the second variant was about expanding the mandatory delegated reporting under EMIR, which means also removing the TR reconciliations. It will not imply also the full split of ETD versus OTC, but at least it would deliver this key measure that to address one of the key cost drivers. And then the third variant would basically work on top of this expanded delegated reporting model. We'd also add a partial delineation by instruments by dropping the ETDs from EMIR, but not doing the same for MIFIR. So it would be like something in between the full option 1A. And the overall objective of this exercise is to ensure that we have intermediate measures that do not involve a comprehensive redesign of reporting, but at the same time, also they do not mean shortcuts in the sense that they don't reduce burden just for the sake of reducing it, or they also maintain supervisory oversight at the same time. So importantly, also we need to be mindful that this intermediate step will need to be compatible with the longer-term target solution of integrated reporting across MIFIR, EMIR, and SFTR. So, for example, in the context of the dual-sided revision, if you have a scenario where you have 2 financial counterparty and you need to apply the mandatory delegation model, you also need to consider that these 2 financial counterparties might also be subject to MIFIR, and therefore there is this need to pass the client information if you move to a mandatory delegated reporting model. So this is something that might not be actually welcome in this specific scenario. And this is something that we also discussed as part of the workshop that we had earlier this week. And I will give you a bit more details on that in the next slides. Moving on to the results. Okay, so the Deloitte based their analysis on a clearly defined methodology that has been applied also in other impact assessment for policy proposals at the European Commission. It is the Better Regulation Toolbox that is used and defines the whole methodological approach. That means that the costs and the benefits are assessed over long-term horizons, over a 10-year horizons, and they are assessed applying the standard net present value methodology. This approach basically is aimed at providing a quantitative framework for evaluating the economic viability of regulatory proposals, which is, as any policy change triggers the need to implement some change, so some investments are needed. But the question is how these investments are then recuperated and also translate into benefit in present value terms. So by comparing the benefit of the target option with the status quo. And the analysis was informed by a detailed cost survey that was run with a representative sample of market participants. You have there the 4 segment that was covered by the analysis. It was focused on 3 key cost assessments. So first of all, the assessment of the recurring operating costs that are there today under the status quo scenario, so the run cost and the change management cost. The second cost line was the implementation cost for transitioning from the status quo to the target solution, with incorporating the intermediate variance that I described. And then the recurring operating cost was the third element. So the recurring operating cost that we should expect after the implementation of the target solution. And these elements supported the calculation of the operational savings, and they were discounted then to assess the overall net benefit. And here in the slides, you see the results of both the yearly savings from year 2-3 of the implementation, and then also the initial investment needed to transition to the target solution. On the results, we have another, the next slides that gives you a bit more detail, and that relates to, first of all, the sample of entities that was covered by this cost benefit. So each stakeholder group has an equal weighting in the cost benefit analysis. We have covered 30 entities across 4 sectors. So buy side, market infrastructure, non-financial, and sell side. And the composition of the sample was, of course, done in cooperation with Deloitte, but also with the national competent authorities that are represented under the Data Standing Committee of ESMA. And we based it also on quantitative criteria. So we looked at the reported volumes of this entity to make sure that we had top reporting entities in the sample. We also were mindful to be balanced to make sure that also the type of stakeholders that were less represented in the call for evidence responses were covered significantly. So we had in particular attention to the non-financial corporate sector, which gave us less feedback in the call for evidence. And when it comes to the findings for this 30 sample, these are clear. So there are material savings emerging after the implementation phase. We are now working on a methodology to scale this result to the full market and to apply a more meaningful weighting for all the type of market participants. And this will be based on number of entities and also reported volume. For the 30 entities, we did not have this type of sophisticated weighting. So the weighting was quite linear, meaning that the savings that we have estimated so far, that Deloitte has estimated, in fact, were calculated regarded or the weight of the entity in the market. So they are quite conservative in a sense, because the sample was very heterogeneous, representing all type of market participants. But then the one that with the highest reporting volumes or the type of participants that represent a higher number of reporting entity within the total market was not weighted more or less. So that means that basically what we have now is a net present value that is positive under a very conservative approach in the calculation of the saving. And assuming that we have beyond 7,000 entities reporting under the 3 framework, it is clear that we have an impact that is quite significant and will bring quite a high number of saving. I think with this one, I can move to the last slides for this part. So here is just to also flag that on top of the quantitative information, we also received qualitative information, additional one as part of the cost survey. And in particular, Deloitte paid specific attention to the information related to the cost driver. And we can confirm that the top 3 cost drivers that were reported also under the cost benefit are very much aligned with what we've seen in the responses to the call for evidence. So dual-sided reporting and the linked reconciliation is one of the top 3. It is actually the top 1 cost driver for the non-financial entity. Then we have regulatory complexity, and this is due to the frequent and unsynchronized and unpredictable changes, which makes the whole change management process very difficult and challenging. And finally, the duplicative reporting due to the overlapping scope across the various frameworks, but also due to the proliferation of reporting channels. With that, I think I can stop because I've seen that there are more questions coming in, and then we can move to the next part of the presentation.
Maybe I can take I can take one of them, in particular from Deutsche Bank, on the need for reporting entities to reconcile multiple times and at different levels, in particular for risk mitigation purposes. Indeed, originally the expectation was that portfolio reconciliation will ensure that the quality of the data was high and the focus on the data quality was achieved. But then this was not the case. On the contrary, without the level reconciliation, the quality of the data reporting presented some challenges from the start, and that's why we introduced the TR reconciliation that provided very useful, impact in terms of data quality reported, data quality of the data reported. But now we also understand the reporting entities and reporting practices evolve over the time, and the counterparties put in place the necessary processes for ensuring the consistency of the reporting or the reported data, and that's why now we are considering to reassess, whether or not it's needed to perform this kind of TR reconciliation, because under a model where we will have an expanded delegation of reporting and the reporting will be delegated to one of the two parties, the reconciliation at TR level are not longer relevant. So it's just after the evolution of the different frameworks over time and the readiness of the different counterparties to evolve, in this particular context is why we are now considering expanding the delegation of reporting. Yep.
Thank you, Javi. Maybe I can take also, there is a question for clarification on the 9 million savings after the 3 year. So the question was whether the savings are calculated across the 30 entities or per entity. I confirm that the costs are calculated across the 30 entities. So the 9 million savings is after the 10-year period. And these 30 entities start saving 1.5 million per year, starting from year 3. So that is the net saving, of course. And then we have.
That's why we can just move to single side.
Why we cannot just move to single-sided? Yes, there was also a question from SMP on this one a bit earlier, but as I said, we need to balance the need to address the compliance costs, so to reduce the compliance costs, with also the need to preserve the quality of the information. The information is not just being reported for the sake of being reported. It is reported for the purpose of performing specific supervisory tasks stemming from risk monitoring to market abuse surveillance. So it preserving the quality of this information means preserving the integrity of financial markets and the systemic risk, the financial stability of financial markets. So the idea is here to have a model that does not completely make the whole reporting exercise meaningless or less reliable, but a system that maintains some level of communication between the two parties of the trade without resulting in a burdensome exercise that you are facing today, where you have to react to each and every reconciliation breaks and all the data points that are being covered. So this is, as I said, it's something that we can also further discuss in the implementation phase, and we're open to see what could be the right balance when it comes to maintaining the data quality, but we cannot completely disregard this principle and the need to preserve it.
Maybe on the CBA, I think we have very technical questions on the configuration of the MPV calculation, how this was calculated. The CBA was performed by an independent consultant, and the report will be published as part of our final report. So we will defer, the comments on specific calculations for that moment. These were just the preliminary results on the key element, on the key target solution we are assessing as part of this CVA, but more information will be published very soon on this matter as well.
Okay, is there anything more that we need to maybe?
I think most of the questions were related to Alzheimer and responded to them, and the rest were on the CVA and what just mentioned on the actual calculation of the MPV. So I think we covered the key ones, and there's no other.
Last one that came in, since the target solution is not clear, e.g. one-sided or dual-sided, how do you calculate the cost benefit? Well, the target solution, in fact, is what is being described as the option 2A in the call for evidence, which basically assumes that you will have one reporting framework for the three existing for the three regimes that we have today. So basically merging EMIR, MIFIR, and SFTR under one framework for reporting. And the benefit of this solution would be that you would have an integrated reporting template, but you will also have all the changes that will stem from reporting in the future being driven by just one framework, meaning that you will not have unsynchronized changes depending on which framework is being reviewed in Brussels. And also you will have an assessment of the data points that are needed under this super framework from a holistic perspective. So not by looking simply at one specific regulatory purpose, but really trying to see this as one data set that can serve multiple purposes. And this would, in the assumption, this would reduce in the end the number of fields that are required. So another question, will ESMA review all questions in the chat post-hearing? Yes. Yes, we will also have a look at that. As I said at the beginning, there are many participants today, so we are trying to filter to the extent possible also to make sure that everybody is heard. Okay. So let's, now we want to give you a bit of an overview of what we discussed also with the respondents to the cost benefit analysis. So we wanted to have this interaction also with the respondents to make sure that, first of all, the assumption of this exercise were well understood and there were no misunderstanding on the way the calculation was made. We also wanted to collect qualitative feedback from this entity, given that they went through quite a significant effort to provide the cost information. So we wanted to also see what were their qualitative perception of this exercise. The idea of this workshop was basically, it started with a presentation of the results of the cost benefit as we are doing today at the open hearing. But then we split the participants into 3 structured breakout sessions, and we had more focused discussion on the key measures like dual-sided reporting revision, the intermediate simplification measure that we want to provide as early as possible as a relief, and then the streamlining of reporting channels. And the idea, as I said, yes, was to validate the assumption and also make sure that it is clear that we have identified the key cost driver, and also what are the pain points that can arise under these 3 specific measures. So starting with dual-sided revision, and maybe Javier, you can give a bit more color on the intermediate step as well. So on the dual-sided revision, we clarified that in the context of this mandatory delegation of reporting under EMIR REFIT, TR reconciliation no longer apply because they just linked to the dual-sided schema, so they will no longer be relevant in this context. Many supported this clarification, but there was also a question as to why not moving directly to pure single-sided reporting. And this was clarified as well, as I mentioned earlier to some of the questions that were raised, that we need to maintain a minimum level of communication between the 2 parties to preserve data quality. At the same time, this should not mean that the same level of effort is expected in the context equivalent to what is expected today in the context of reconciliation, but we still need to find a mechanism to make sure that this communication channel is maintained. And then assessing what can be considered the acceptable level, that can be also further discussed in the context of the implementation. It does not necessarily need to be enshrined in a level 1 framework. In fact, it would be counterproductive to have such a detailed point in the level 1, which would then be irreversible for the next 10 years or so. So the idea was to continue the discussion on this point. And based on this clarification, there seemed to be quite a broad agreement on the fact that this measure should be expanded to all reporting entities. So it's not something that is only beneficial for financial and non-financials, trades between financial and non-financial. It was also recognized that it could have value for other scenarios, for the scenarios that are involving two financials, for the scenarios that are involving two non-financials. But the difficulty here is that it is very difficult to have a level 1 rule that would clarify the reporting responsibility for each and every scenario. Because especially when it comes to trades between two financials, the burden reduction benefit vary depending on the type of counterparty. So you might have a scenario where you have a CCP and a clearing member, for example, where the case for the CCP reporting is clear. But then you might have another scenario involving two investment firms subject to MiFID reporting, where you will need to define another criteria based on which assigning the reporting responsibility. And at the same time, not all financial entities are subject to MiFID reporting. So you also have the case where you have one entity that is subject to MiFID and one that is not, for example, and you don't want to bring new entity into the scope of the reporting. And there is also the question of passing the client information. So clearly this is something on which the sell side participants who participated in this discussion recognize as something that could be a blocking factor for them to move to this type of logic. So on that, several solutions can be conceived. You can have an approach where only some part of the data points are passed on and others are reported separately. But it's, again, something that is so detailed for a level 1 recommendation that, in fact, the conclusion for this breakout session was that for this type of scenario, there is a need to have flexibility at the ESMA level to ensure that the details and the approach can be ironed out later. So you can have like the general principle, mandatory delegated reporting across the board. You can have a general principle. It should be based on the more sophisticated party doing the reporting. But then when it comes to the scenario and the logic, it would be appropriate to have a mandate for ESMA to further define and iron out the details. Okay, given that this is quite a hot topic and I see more questions coming in, maybe we can see if there is anything that we can also comment on the latest question. Yes, so there was a question to just recall the key cost driver and what we're trying to address. So the top one is the dual-sided reporting obligation and the TR reconciliations that are linked to this requirement. The second one relates to the regulatory complexity, and this means the frequent and synchronized changes that are due to the fact that at the moment reporting is sectorial and is not under one specific framework. And then the third one is duplicative reporting due to both the overlapping scope, but also the multiplication of reporting channels. Yeah, please go ahead.
Yeah, we had another session focused on some additional simplification measures that we are considering for implementation in the short term. The focus of this holistic review is mainly focused on defining key policy choices at level 1, high-level decisions at level 1, But at the same time, based on the feedback we have received and the call for evidence, and also in the CBA, we identified that there is still room for additional independent measures that can be implemented in the short term and provide alleviation in the burden for the firms without impacting the target scenario or without impacting, the current systems in a way that, suppose or implies a lot of implementation effort. So essentially, we are looking here at simple but still efficient measures with a good balance of cost and benefit that can be implemented without waiting for the full development of the target scenario. We discussed with the participants on the CBA on these measures. I think overall the discussion was very constructive, and overall participants supported the measures we identified there. For a full list of these measures under consideration, we can refer, I think it's point 4.9 of our interim report, where we listed all the different measures identified by the industry subject to further assessment. Some of them, for example, relate to the bar reporting period that we currently have at 5 years and we're pursuing to reduce to 3. Also, how to streamline, for example, the mere intergroup reporting or intergroup exemption notifications. Also, if there's room to reprioritize some of the optional fields we have under MiFIR. Also, the list of the definition of a transaction we have in that test 22 of MiFIR. So there are a number of different measures that are, let's say, independent for the target solution that we are considering also for short-term implementation. And I think most of them, if not all, were highly appreciated by the industry during the workshop. And we will try to continue our assessment on them and provide more clarity during the recommendations in our final report.
Okay, so I think with that one, then we can move to the last slides. There is a question on the timelines, but this is actually relevant for the next slide that we have. Timeline and next steps. So just overall on the timeline for this exercise, as shown also in the slides, we had really a sequential approach and an evidence-based process. So we started with the call for evidence, and then we analyzed the qualitative responses from the industry. Lucky for us, there was strong stakeholder engagement already at that stage, so good input feeding our work. We then moved into the cost-benefit analysis. We launched this after we selected an external consultant in November. And this cost-benefit analysis was, as I mentioned, driven also by the responses to the call for evidence and the key options that were identified as the most supported. And now we are finalizing the analysis, and as I said, the final report that we are targeting for early July is the report that will contain the key recommendation for changes in level 1 that will then enable us and form the basis for us to work on the implementation. Importantly, what we wanted to stress is that the part related to the level 1 changes is something that is beyond our control. So it depends on how fast these changes are recognized and incorporated in a legislative framework in Brussels in the context of the current negotiations of existing legislations. And then starting from there, we are working also to have a bit more detailed estimate of the implementation part, which is the part that we can control. We will try to give as much detail as possible already in the final report on that. We can already tell you that we are aware of the urgency, and we are trying to, at least for the implementation, have a bit more aggressive timeline than what we presented in call for evidence. But at the same time, we still need to be mindful that this first step, which is the level 1 development, it is out of our hands. So it is really dependent on legislation being passed in the context of the current framework. Could be already beginning of mid next year. I hope that was clear enough. I don't see any more questions in the chat, but I'm mindful that there were many interventions and we've been trying to filter as much as feasible, but we have time. So I wanted to now open the floor to everyone, those who have already included the questions in the chat, but also those who didn't yet, and have managed to form some views in the course of this presentation. Maybe we can take also some oral intervention then, and whoever wants to start, and then you can put the camera on and taking for maybe a raise of hands first, because otherwise it becomes unmanageable.
And maybe while we allow the participants to do that, just respond to one question in the chat. I think it's from the corporate investment banking branch of Crédit Agricole, and the question relates to the errors and omission report and whether this can be subject to further simplification. This report is a supervisory non-transaction reporting to further support the NCA's understanding of the quality of the data reported, and we take note of this proposal and we will assess further whether simplification can be achieved also in this one, and also the possible interplay with the single or dual side reporting model.
If anyone wants to raise a question, as I said, don't be shy. You can raise your hand, and we would take the advantage that we have still some time to address it.
And the cameras and the mics are mute indeed, but the moment you raise your hand, we will open them so you will be able to speak.
In the meantime, I can see that there is one more question in the chat about MMSR report to ECB. So just to clarify, as we said at the beginning, we decided, based on the feedback to the call for evidence, to limit this first step of the exercise to simplification across EMIR, MIFIR, and SFTR. That was a conscious choice given the breadth of the exercise already, and also the feedback that we received from the market that was any more ambitious option going beyond EMIR, MIFIR, SFTR was considered too complex and ambitious for this stage. So we might consider it as a later step if this work materializes and is successful. Yeah. Yeah, there are questions now.
Maybe a last one from the chat before we open the floor. This one from KDPW, the repository, on whether there is a report on the analysis on the use of data for a range of the different reporting regimes at national level, and if so, if this can be public. Let's make it short, yes, there are several ones, but the key one is the ESMA report on the quality and use of data. The latest edition will be published in the next couple of days, and this one covers around 15 different data sets we get access to. So this can be a reference document for responding to this question.
Okay, so we have then, I don't know who raised the hand for, I think David. Yeah, David Zahari.
Hi, yeah, thanks very much. I'm David Zahari from ISDA here. Can I just please return to the costs that were being described in the cost benefit analysis section? I perfectly understand that the point that after year 3, the expectation is that firms would experience a 1.5 million euro cost saving per annum. What were the figures of 9 million and 30 firms in the 3 years prior to that? Was the implication that those 30 respondents would be expected to save 9 million between them over those 3 years? In the next slide, we talk about 9 million and 30 institutions.
Yeah, so that is basically the overall saving calculated for the 30 entities in the sample. Yeah, not per entity, it's for the whole 30 entities.
Okay, thank you.
Thank you. Another, Ambra Moschini.
Thank you. Thank you very much. I'm Romaskini from Amafi. I had a few questions. First of all, I take over from David on the cost-benefit analysis. So I just wanted to understand if this analysis is a joint cost-benefit of option 1A and the several sub-option on 1A and option 2. So is this actually a comprehensive cost-benefit analysis of the two steps? So the two steps considered, in the cost-benefit analysis.
Thank you, Amber. That's a very, very good question. And yes, this was the scope that we asked Deloitte to cover, with one caveat. So basically, we had assumed that the option 2A, the target solution, will cover these steps that are under option 1A. So over the 10 years, these components of option 1A will be implemented as part of the target solution. What was not assessed was how whether this, whether it will bring savings to implement this intermediate step earlier.
Okay, I see. And do you have maybe in the final report, but the difference between the three sub options, because the cost benefit analysis that we see here is only have one result, but maybe the result is slightly different according to the sub option that we choose. One I or double I, or I don't know if in the final report you actually expect to show the difference between the three sub options.
Indeed, yeah, I think so. There will be some details also on the assessments of the variance and the related costs. At the same time, just one more caveat on the cost benefit is that not all participants agreed to the disclosure of the cost information. So it will be still aggregates. We're still discussing with the Deloitte exactly the extent to which we will at which level of granularity we will need to publish this.
Okay, thank you.
Paste.
Yes, that fog. I think.
Very
I
good.
hope
Can you hear me now?
Yes.
Can you hear me?
Yes.
Oh, brilliant. Very good attempt at my name. It's very challenging. I was wondering how you would do. So I think I very much welcome this opportunity by ESMA to review the regimes. It's 12 years in the making so far. And so we need to relook at all of the fundamentals of why we do what we do and how we do it, such as why do we do valuation reporting? Why do we do collateral reporting on a trade-by-trade basis, where we're already doing that type of activity through other risk mitigation techniques? And we can inform you of that. So we may not need some of these fundamentals, we may not actually need at all. So hopefully this review, legal confirmations, timely confirmations on a trade-by-trade basis, rather than an attestation every year, for example. I hope that this review goes to those levels of fundamentals. Also, another comment here is what we've seen in the industry so far is that there are a lot of synergies between EMIR and MiFID, not so many with SFTR. So where we look to combine templates, I would hope that we take a lot of consideration about SFTR. Unless we re-engineer the entire SFTR process, it may actually cost us a lot more money to harmonise than it would save us, even in the very long term. But I do welcome this opportunity, and I thank ESMA for being an honest broker in this process.
Thank you for this intervention, and maybe I can take this point about the SFTR. So, well, first of all, the intention of the simplification is we don't want to fix what's not broken. So clearly, we know that for SFTR there are some specificities that are best captured with the current SFTR templates. There are some synergy between SFTR and MiFIR in the sense that there is actually one type of trades that is currently being reported under MiFIR because exempted by SFTR, and that is the trades with counterparties to central banks. So, for example, that could be a good candidate for actually simplifying MiFIR by bringing these trades under SFTR. But then also another synergy or possible, room for simplification is from the perspective of the reporting channels, of course, because there both SFTR and EMIR are reported under the TR model.
Yeah, maybe to complement very quickly on this, actually the inclusion of FTR in the overall process was one of the takeaways we got from the call for evidence results, where participants indicated that the FTR should be subject also to this review. On top of the points that Julia mentioned, also there are implications, for example, on the dual side versus single side, expansion of delegation of reporting. These are elements that are common also across EMIR and SFTR, and we will address them together. And probably as a more general statement here, but we are looking at very high-level identification of policy choices. So we will have more time in the future to discuss on the specific implementation, how the templates can look like, and also the use of different data, how we can cover multiple purposes with the same template and this kind of stuff. This is more for further consideration in the future once we have a clear direction of travel. So.
In the meantime, waiting for other hands to be up. So I noted a question from BNP on the example of MiFIR post-trade transparency and the fact that the current single-sided reporting has a wide acceptance and the data quality is being enhanced. So why not to go over the same thing for transaction reporting? And on that, yes, we wanted to, well, first of all, let's clarify. This exercise is only about supervisory data, so granular transaction data used by supervisor for their duties. It is being reported according to a different scope and also, importantly, according to different timelines, because you need to report on a T+1 basis, while for transparency, it is like an immediate reporting obligation. So the consideration is a bit different in this context. And for that reason, we don't necessarily think that exactly the same model could work for supervisory data. But yes, we are open to discuss the level of and how to ensure that data quality is preserved in the context of supervisory transaction data in a way that is different from the current way, which is the one-sided NTR reconciliation.
Maybe to complement a little bit, it's Olga Petrenko, ESMA Chief Data Officer. First, can you hear me?
We don't know because they're muted.
Muted.
We can hear you.
Yes.
Yes. Okay.
That's okay. Thank you very much. Second point, maybe a little bit indeed to zoom in on the fundamental difference between transparency publication requirements and supervisory data collection. Transparency is very much, as Julia was mentioned, about a momentous notification about the trade that has taken place. It's about the fact that there was an activity on the market, about its timing, about its quantity, about its price, about the instruments. That is what matters in the transparency. When we talk about supervisory activities, many other considerations come into the play, and most prominent of them is who is behind the trade. What was the ownership of that party before the trade? How has that party's ownership or position or acquisition changed after the trade? It's most probably something that many of you have heard, the infamous follow the money principle that prevails across all supervisory activities. For that, you do need to know to the level of identities of individual participants, regardless of whether they have sold or bought. In both instances, the version of the accounts held by a party after the trade is equally relevant and equally important. And this is why pure single-sided doesn't fly when we talk about market abuse investigation. It doesn't quite fly when we talk about systemic risk, because it's not present on one just part of the market. It's present across the board, and exposure of each and every individual entity is very, very much relevant in each and every case. Then it's true that experience shows, and that's a common sense, that sophistication of parties are very different, instances are very different. We, as Dodd was saying, collectively have learned where are the key pain points and how they can be proved over time, and that's exactly what this exercise is about. It's how to find efficiency gains and attempt to exploit them without jeopardizing the fundamentals of supervisory capabilities. That do really, they stay on top, they remain on top. This is something that we articulated in the cost call for evidence, apologies. This is something that continues driving the work and discussion with the competent authorities. I very much appreciate that from your perspective, the focus indeed is very much on the things that hurt you most. And we're truly coming with, thank you for that. Very creative solutions sometimes on how things can be improved. And I can assure you that all of those solutions are tested and considered, but they all need to pass the test of would the supervisors still be able to supervise the market with the same level of assurance and effectiveness as they do today. We are having our own conversations with competent authorities that they would need to adjust their processes, and that's not always an easy conversation, but there is an acceptance that also on the supervisory side, we will need to find ways and room to do something differently perhaps, but the prevailing objective remains the same. Supervisors need to be able to supervise exactly the same things that they're supervising today. And that means that radical changes like pure single-sided, where only one part of the story is known, is not much of an option to be considered and discussed. While we're very much open to discuss what we can simplify while retaining certain form of accountability on the side of both parties. And that in part goes to one of the questions in the chat, which was asking whether also the responsibilities in case of extended delegation of reporting, whether there would also be the revision of responsibilities in terms of the content of reported data. Happy to be corrected, but the way we understood the question, it essentially meant, should we move to the extended delegation, would the responsibility for the data also move to the party that performs that extended delegation? And that is not something that is being considered. We're looking at the currently applicable delegation model in MRFIT, whereby the responsibility for the data accuracy remains with each party of the trade. Then the task of passing on this information to wherever it needs to pass indeed could be performed by one of the parties, but the responsibility on the accuracy of the account for what kind of trade has happened and what exactly has been transacted, that does stay with both counterparties. I hope that clarifies at least one question of many in the chat. And then I believe there is another hand coming up. Julia, I give the floor.
Yeah, that's me again. Thank you, Olga. I think the line of that question is around, so at the moment when a party delegates to another, they have to get a copy of the report that was made and then reconcile it internally. That means that they basically have to do all of the things that we would do to create the trade in the first place. They have to have that knowledge, experience, understanding of the entire trade, all of the information that's in it, which is a huge cost. So the delegation itself of the reporting, the act of reporting, costs very little. But so physically sending the report out the door to the trade repository is a fraction of the cost of reporting. The cost of reporting is being able to understand how to report. And so that is the reconciliation that the party who's delegating has to pay themselves. So we're removing a lot of the cost benefit of delegation if we don't reconsider who is responsible for that report as well. And I think that's where the question comes from, really, is that we need to move the responsibility to the reporting party. Because that's where the cost is it's the knowledge and experience and understanding of how to report those trades. And that's where the real saving will come in the market.
On the
Hello.
With the hands up, yeah.
Yes, thank you so much. This is Elena from the European Association of CCP Clearinghouses. And I would have, if I may, a question on the CCP ETD data reportable under option 1A. So speaking with our members, I understand that a potential shift to ETD-based reporting raises some operational concerns. So like post-trade clear position information then would need to be transferred between clearing and exchange reporting teams, and this could create operational complexity and also potential duplication of efforts. And so each members ideally would like to receive some clarifications on like would this obligation for reporting this data just sit with CCPs, or does the MiFID obligation, as it does currently, sit with venues, and then CCPs would simply provide the data? So I don't know if it's a bit too much of a specific questions, but CCPs would very much appreciate some clarity here. Thank you.
This one, indeed, thank you very much. We are aware of this. The final configuration of the reporting flows is still under consideration. We are aware of the pros and cons of different models, also the complexity of some scenarios. I think this was pretty clear also in the feedback we got from the call for evidence, information reported to the different CCPs, trading venues, etc. I think there was kind of consensus on the need to report from, let's say, the golden source, from those reporting entities with access to relevant information. But the final configuration and how the reporting flow will look like is still under assessment, and we will not comment on that more today. But it's something we are fully aware of and we are working on.
Thank you. And if I may just take a moment, maybe for another question. I'm not sure if I understood, will you be planning perhaps to have even some more industry involvement later on, like some targeted sub-working group or consultation structures to support the future work on this project?
Yes, I'm happy to clarify this one. We do plan. There is an important caveat, though, that comes with the answer. The key delivery or key milestone to reach and pass now is the publication of the final report. That's beginning of July. As soon as that happens, our key task from there onwards will be to understand to what extent there is a political appetite to act on those recommendations. We need to understand if co-legislators indeed pay attention to it, consider the proposals there, and we receive at least some kind of indication that this proposals for level 1 changes would indeed be considered as possible changes to the existing level 1 text. We do not necessarily need to wait for all those changes to be introduced. We just need to understand that indeed the recommendations will be acted upon. The moment we're going to have these indications, which hopefully are not going to take too long, that's when we do plan to launch conversation with yourselves on what kind of most effective and efficient governance should be put in place to start working on the implementation details. And there are many. The discussion today, also your questions in the chat do show that one thing for sure, it's not going to be a lack of work discussion, and neither it will be boring, but we would be having a conversation with you how to organize ourselves after we have some kind of an indication that our recommendations would indeed see the daylight and move forward, so to say. I hope you understand that until we have clarity that these recommendations would indeed be considered for the legislative change, there is not much merit to start discussing implementation in detail. I would reserve the right for the moment not to give you any promises on the timeline, because we're simply not the masters of that timeline. While I can assure you, we're very much aware of the urgency, we are equally aware of a very broad interest to engage with ourselves, and we do find this engagement useful by all means. So we would be ready and we would be in touch as soon as there is some level of clarity on what happens with the recommendations after we publish them.
Thank you very much.
David, maybe you can take the question of the UK.
Yes, I was yeah. Thank you very much. So indeed, I think there was a question. I cannot see the name of the participant, but essentially was a question regarding the FCA, UK FCA proposal or recent discussion paper on, and we are aware of this, and also the impact of having Forex derivatives out of transaction reporting. We are fully aware of this proposal. I think the scope is slightly different, and the FCA proposal is focusing on the MiFID overall review of the MiFID transaction reporting framework, while our focus or scope is a bit broader, and we are looking at the different regimes altogether. At the same time, some of the measures we are considering, in particular for those that I mentioned before, independent measures that can be implemented in the short term, medium term. Some of them are, drafted, let's say, which are, degree of coordination with the FCA to the extent possible. For example, the one on back reporting or the one on the exemptions for RTS 22 of MiFIR, so we are fully aware of this. Then regarding the FX derivatives, I think this relates a bit more with the information as code principle that my colleague explained at the beginning, and this will imply a loss of data available for the supervisor to perform the duties. And at this stage, we are not considering this piece of, for the streamline of the regime.
I see that there are still hands up. If you don't mind, David, Ambra, I will give the floor first to SNS, who hasn't spoken yet.
Thank you. I'm from Deutsche Börse, specifically from Eurex. And my question is more related to a specific cost segment only on trading venues. I also put my question in the chat because my microphone was not performing good, so you can now ignore the question there. So trading venues have to report end clients data of third country members, which are not subject to MiFIR. And because of that, we have to report some specific private personal data, names and date of birth of the end clients of our own members. This data is neither generated nor directly accessible to trading venues, and it conflicts with the principle of source-based reporting. In other terms, it also takes costs and efforts to collect and validate the correctness of this data under a very tight deadline, in T+1 reporting deadline. And we also do not want to keep that much this data in our database. It is also in a way not compatible with personal data privacy, but this is less of a concern. Most of the concern is the validating the correctness of this data. So my question is, does the cost benefit analyzer so far takes into account this additional burden on trading venues, or does ESMA have already a preliminary view on this proportionality aspect on trading venues? I remember I saw a comment about this in the interim report, but it was not fully transparent to me. What's your view from ESMA side? Thank you.
I can take it and then feel free to complement colleagues, but yes, so just on the cost benefit and the scope of the cost benefit, just to set the scene. The analysis is on the key, design changes that we envisage as part of the option 2A, assuming that it will also cover some of the components of the variant of option 1A as described in the slides that I presented. We did not analyze each and every specific scenario of reporting depending on the type of reporting entity. This is a conversation we can have in the implementation phase when we get more to the definition of the reporting templates. On the specific case of reporting the data on the third country members, this is a key piece of information to ensure the integrity of European markets. So, I mean, at the same time, you need to understand that if you want to conduct meaningful surveillance, you need to, based on the principle of following the money, be able to track the activity of actors that are participating into a platform and be able so that the alerts that national competent authority have in place to perform market abuse are effective and are not pointing only to the trading venue. They should point to the individual actors that are participating in the market. And we are seeing this already also today in the context of crypto exchanges. This is something that is quite important also to make sure that there is trust in the European markets and the European venue are safe. So it's not something that we're taking lightly. We know that there are also know your client obligation in the context of anti-money laundering, which are also international standards. So again, any data points will need to be assessed also from the perspective of not depriving the authorities from their supervisory capabilities, of course.
Just to complement a little bit with the background picture, if I recall well, this was the MiFID II introduction, and it came at the time where the competent authorities had flagged an important data gap. namely that in the case of transactions executed through the third country firms, members of the European trading venues, the visibility on the identity of the actor actually trading on the EU market stops. At the same time, the probability that these actors may commit market abuse, insider trading, market manipulation, is the same as a probability that any other EU client can commit. And for that reason, the logic was that as long as the trading venue providing the facility for this kind of actors to access European markets, it is an expectation from the trading venues then to ensure the relevant visibility is maintained with the competent authorities. Now, that's the background of it. At the same time, you're not the first one to raise this question, this point, and yes, we have been hearing it over the years. Not necessarily something that we as ESMA staff are best positioned to opine on, because this is a direct implication on the national competent authority supervisory powers. Though there are good reasons to believe, if there are alternative ideas and suggestions how to cover this data gap, other than through the current reporting, that's exactly the kind of conversations that we hopefully would all be collectively having when we move into the implementation phase. I would not say that it's cut in stone and completely closed, that it's untouchable solution the way it's currently implemented, and there is no room for discussion. We're surely going to find a room for discussion, but please be mindful, we would then expect an alternative proposals on how otherwise get access to the information to know identity of individual clients, precisely because their possibility to commit market abuse is identical to the possibility of any other actor acting on the European market and any other actor whose identity is known and is visible on the specific point. I think there are more hands. Maybe we can go back to David.
Yep.
Ambra and then Sander.
Yeah, thank you. Just returning to the question of single-sided, Olga, when you were describing the differences between the rationale for transparency reporting and the rationale for systemic risk reporting and indeed market supervision reporting, leaving aside the market supervision because MiFIR doesn't really have a direct equivalent. MiFIR Article 26 reporting doesn't really have a direct equivalent in anywhere else other than the UK, which obviously came from the EU regime. But in respect to systemic risk reporting, is it ESMA's view then that those regimes, such as CFTC Part 45, that have single-sided reporting for systemic risk purposes, that those are not adequate?
Nice try. I will not respond. Thank you for the attempt. I will leave it to the colleagues. I am also confident that the reporting setup in the US is much broader than just one type of the reporting, and they definitely have different means for data collection, which they supplement their derivative reporting framework. You will hopefully understand this is not neither my place nor the right time to opine on the way peer supervisor chose to organize their arrangement. I will comment on the fact that MiFIR doesn't have analogs elsewhere in the world. MiFIR does have analogs elsewhere in the world. It is structured perhaps differently, and sometimes that is entrusted to self-regulatory organizations, as is the case in the US. But it wouldn't be fully accurate to say that the transactional reporting setup we have in Europe under MiFIR is something exclusively and solely specific to the EU and the UK. It definitely has analogs elsewhere in the world, organized sometimes substantially differently, but it is there.
Yeah. Sorry, that wasn't really the main point I was trying to make, but I agree with your point there, certainly. Okay, well, thank you.
And we have more hands, Ambra and then Sander.
Yeah, thank you. Just wanted to come back on delegated reporting, mandatory delegated reporting, and the shift of responsibility, because for how I read the interim report actually on point 72, so the ESMA interim report, and understood that the model that was suggested is the one that is actually under Article 9(1)(a) of EMIR, and under this article, actually the financial counterparty that needs to report for NFC minus, they actually became solely responsible and legally liable of the reporting. So this means that the counterparty is not responsible anymore of the reporting. So it doesn't really need to make any kind of control on what has been reporting on their behalf, but they are actually the only responsibility to give to the financial counterparty the information that they need to do the reporting correctly. So this is how we understood it should actually work. So the responsibility was not kept for the two counterparty. So maybe this is the first remark. On the second one, so I come back to what David said on single-sided reporting. I think that we have to put MiFID on the side, because as you say, it is specific and is really complicated for market abuse to consider that only one counterparty report. For SFTR and EMIR, what we thought is that since the delegated reporting finally, as I've written in a comment, is only one technical mirror of one transaction that is reported by one counterparty, even if the supervisor has the two sides, actually the two sides can be wrong, because the financial counterparty will only take his transaction and duplicate it as a mirror. But if they are only solely responsible of the reporting, they will get the information of the counterparty up front, and they will do the reporting for both. So the fact to keep the two sides will not add any value for the supervisor. They will only be technical burden, for the reporting entities. And the last point, we didn't really talk maybe about the proposal to delete ETDs from EMIR, that we thought that was a good point too. I don't know if there are any issue on to move forward to this point, but we think that this is something that should be considered too, because it will reduce, of course, the burden. Sorry, took the 3 points on one, but thank you.
Maybe I can take the first one on the dual side and the understanding of the proposal. Indeed, you're right. I think we are leveraging of you mentioned in EMIR and also in SFTR 12.4. But again, having the possibility for other sectors, this is what we currently are assessing. I want to put emphasis on the second part of your question, the responsibility of also of transferring the relevant data to the reporting entity from the non-reporting entity. I think this is a key pillar as well. And we want to preserve this communication mechanism that we think after many years of reporting is well established and is one of the leverage the levers to move forward with this kind of proposal. That data quality of the data report, it should be preserved. This is a fundamental pillar of the reporting framework, and I think this part of sharing data before the transaction is actually reported is a key element that we should preserve. So the responsibility from the non-reporting entity to share this data with the reporting entity will remain, and again, will be key to keep it and to put emphasis on it. Maybe for the other colleagues, you can help with the rest on the ETDs.
On the ETDs, again, this option will need to be also assessed from taking together not only the cost benefit for the market, but also the one for the authorities. And it is the variant that provides less, a bigger information gap for the risk supervisor in particular, because moving ETDs, dropping ETDs from EMIR would mean that there would be, until we get to the target solution, there would be quite a significant period of supervisory gap because the data on margin evaluation will no longer be there for this type of products. So it is a question more for to assess whether, from a supervisory perspective and in the light of the preserving information value principle, is still valuable. It is also being assessed as part of the cost benefit in any case.
Yeah.
Yes, Sander?
Look, sorry. Look, we certainly welcome the approach that ESMA is taking here, and definitely the open dialogue, I think, has been very helpful in going through this process. I guess I have three kind of points to consider. I mean, have any considerations really been taken in terms of the increased costs for some firms that would have to undertake the mandatory delegated reporting, given the approach that is being proposed really shifts the burden to those that have to do that mandatory delegated reporting, they will have increased vendor costs because of the increased volume of reports they're then required to do. They're going to have increased costs to increase client teams to be able to support the additional information transfer that's beyond what's there today. And this really seems to negate some of the savings that ESMA is proposing. It may help some firms, but it certainly increases the costs on others. And similar to, I think, what was mentioned by Ambra, it's really a mirror report, but with additional information provided. So I do wonder, have those costs been considered as part of this proposal? The second point I think that's important to consider is particularly given this proposal is also being considered under option 2A in the future reporting framework of a single report once thing. If you look at the MiFID transaction reporting style data, I think there's substantial concerns around the type of information that would need to be shared, particularly PII data, given obviously MiFID 2 includes PII data as part of the reporting for market abuse transparency. And so firms would not want to share this as across firms, and hence the mandatory delegated reporting approach. Does that really work in the report once model, given this information would then need to be shared? And I wonder, has that been considered under the lens of this future framework? And the last question I have ESMA also considered the view that other parties could also do some of the reporting, namely CCPs, because if you consider things like EMIR today, much of what's being reported is actually CCP data that's just transposed into firms' own reports, and actually having CCPs report data directly to ESMA would actually save some burden and reduction in terms of reporting volumes for firms.
Thank you, Sander. So there are three questions that maybe we can take the first, and then Javi help me out here. On the first one, when it comes to the increasing costs for the party undertaking the responsibility of reporting, this measure is part of the variants that have been assessed in cost benefit. There is a cost, and it was flagged by the sell-side participants who participated. There is a cost in implementing this measure. At the same time, this cost will need to counterweight it with the benefit that the removal of the reconciliation requirement brings. So clearly, that is something that we need to be balanced. In terms of the scope of the delegation, so the scenario where you have two financials, there is a clear value in considering the scenario of CCP and clearing member, and this emerged also in the workshops that we had earlier this week. There is a clear value here in having the CCP taking the responsibility, but this is only one of the scenario in the context of financial trades. And so we consider that this scenario, in addition to all the other scenario where you might have firms that are subject to MiFIR involved in the trade, and so there is a need to pass the client information. All these are scenarios that should be assessed as part of level 2 implementation measure, having also in mind the target solution that you're referring to earlier. So having in mind the integrated template that is covering EMIR, MiFIR, and SFTR. What we are considering then as a takeaway from the discussions and also the workshop we had is that while from the principal's perspective we could have a rule based on the most sophisticated party taking the responsibility, then we would need to also have a mandate for ESMA to define in a more flexible manner each and every scenario. So that is where we are heading towards on this topic.
I think you respond to the three of them because you respond to the CCP1, to the personal information as well, and the first one on whether or not we are assessing this as part of the CBA. So that's easy for me.
Yes.
Yeah, an important question in the chat from ING Bank. Do the timelines and the interim report showed midterm changes and long-term changes impact the current revision schedule of level 2 amendments? Brackets current moratorium until October 27. So the answer to this would be we would indeed wait, as I mentioned previously, to see what would be the reaction to the recommendations of the publish, and what is the co-legislators' take on those proposals, and to what extent there is openness to consider them. If there is, and then of course we would be looking into level 2 changes only to the extent that they're compatible with long-term vision and direction. If there is no appetite to embark in any of the proposals and the recommendations, then we most probably would need indeed consider going back to the drawing board and discuss lifting up the moratorium on level 2. But it's too early to say in practice today on the 28th of May what exactly is going to happen to the current level 2 in short term until there is greater clarity on the reaction that will follow to the publication of the report with recommendations. And maybe one more point, also one of the more recent questions, BNP, the question on the MiFID data. It's a longer question. I'm not going to read all of it, but it's the question that comes from Kentan at 1549. And it's the question on basically how the MiFID transaction data is currently used and whether all of what is being required is actually required, or instead only a core data set could be reported, and then all the additional information could be requested by regulators when they decide to pursue a specific case. So not being a supervisor myself as of right now, and speaking under control of colleagues from NCAs who I know are on this call, my answer to this would be that when designing current MiFID reporting requirements, it's not to say that already back in the day there was no expectation on the proportionality and justification for each and every data element. It already was there in place, maybe not to the extent that today, but it was neither an open and a clean slate type of exercise where whoever could put whatever they wanted and this ended up in the technical standard. No, in fact, to a big extent, the current definition of the reportable fields was modeled on the basis of the de facto implemented surveillance algorithms run by competent authorities in order to identify suspicious activity. Or those requirements were modeled based on identified data gaps that did not allow authorities to monitor proactively certain activity which they had evidence was taking place and was causing disruption in the market. So to that sense, indeed, absolute majority of the fields, and I will qualify what absolute majority refers to in a second, absolute majority of the fields indeed is being continuously fed on daily basis upon their receipt into the analytical engines in order to identify the suspicious activity. And if you look at the definition of what qualifies as a market abuse, the list is rather long, and it's further fine-tuned which activity qualifies as suspicious. It's rather long, and it's further fine-tuned to adjust to the specificities of specific markets. And in that sense, if we were trying to cut down tremendously the current requirements, eliminating information on the decision makers and eliminating information on trading algorithms, eliminating information on the end clients, where there is a lot of detail, in fact, those ad hoc requests would consume so much time and so much activity, because on daily basis, middle-sized authority receives up to couple dozens and sometimes if not hundreds of red flags for a given day that they need to investigate and look closer before deciding whether the cases were potential or not. That kind of first screening is not feasible on a data set that is anything less of what we have today, because that data set was put in place precisely to ensure the basic monitoring activity. Now, I said majority of fields, and I go to that part. Indeed, there are certain elements that we know already now could be reconsidered, in particularly data elements which could be obtained through central reference sources, data fields that we collect through other referential third-party acquisitions, and so on and so forth. There are such. They definitely are on the list of the fields to be reconsidered. To what extent that would tremendously lead to the decrease in the number of fields necessary for the market abuse surveillance, there I would invite everyone to manage expectations. A lot of details on the identity and the participants to the trade are the core information for the ongoing daily monitoring on the activity by the competent authorities. Do we have more hands?
I think we have
Now, I'm mindful we did not necessarily.
that one.
Let's go to Tony.
Hello, can you hear me?
Yes.
Oh, yeah. Yeah, thank you for today. So it's Tony Holland from ISLA. I was just thinking, I know we're discussing what the report says, but I was just thinking what the report doesn't say, and just thinking, obviously, from ISLA's point of view, thinking about SFTR. So just playing devil's advocate, but if we're talking about the reconciliation, so thinking about pairing, matching and reconciliation, and what actually happens if the reconciliation is not removed. So I notice in the report there's words used around reconciliation, such as revision, review, and not so much removal. But I was thinking from the report, what it doesn't say, if the reconciliation remains in place, some examples of today's problems are the following. For example, if you've got an event date greater than a reporting date, that updates the daily activity report, not the trade state report. That's problematic because the trade state report feeds the reconciliation. So these are the problems we face today. Other challenges are maturity date can't be changed more than one day. Other examples are the report talks about the frequency. So T0 versus T1, and it looks like the frequency of reporting is suggested as not to change, which causes a problem today, because if counterparty A trades with counterparty B, one trades T0, one trades T1, it's a catch up on the reconciliation. So unless we move towards what I think of EMIR have done, using the event date rather than the reporting date, that's still going to be a problem for reconciliation. A couple of other challenges we see today, our tolerances are very aggressive. And if you look at SFTR, we've got 155 fields, 96 are reconcilable, and 83 of those are zero tolerance. So these just may be other things, if the reconciliation remains, that should be looked at, rather than just assuming it just carries on. And also, I think the report talks about the fields in terms of the level 2. So it looks like the fields will be looked at in terms of what our priority when the level 2 changes become about. But I'm just wondering, again, our challenges around the fields, do all those fields need reconciling? So I'm just thinking, just playing devil's advocate, if the reconciliation remains, what else could be done to make more two-sided recs work? Thank you.
Thank you for this. Thank you for this intervention, and indeed open to receive this input. It very much sounds like the kind of conversations we hopefully would be having once we move into the more technical implementation discussions. And as you rightly say, we first need to see what exactly stays and in what form. And once there's clarity on that, yes, we would be definitely open to go into further reflection on possible improvements within the context of reconciliation where it's going to be retained. And yes, just to confirm, I believe there were also some speculations to that extent in the chat. Indeed, while level 2 is not on the table today, it's because we are trying to really figure out above all the level 1 and the level 1 and the interaction within level 1 across the 3 frameworks. Once that is settled, yes, there is a lot of work on level 2, and we ask you all to be kindly patient on that, but there's definitely much more discussions coming on the technical standards, on the tables, on the content, on the individual fields, and so on and so forth. But since we approach this as a holistic review, and since we approached it as an integrated project where, to a big extent, the decision to do so was driven by continuous and numerous complaints about the overlaps within the frameworks, about the inconsistencies within the frameworks. This is what has driven our choice to start with the all-encompassing level 1 critique, if we can put it that way, precisely because unless we solve or address or look into the fundamentals, there is limited room of what can be done for level 2. Not to say that there is no room. It definitely is, but with those level 1 overarching complexities remaining, any benefits of level 2 further revisions, they are capped to a substantial extent.
Sorry, it's Tony again. May I just ask, is there a timeline around the level 1 horizon, how that's going to look? Any
As I mentioned, yeah. Well, we published the report in July, and then it's really the question, what would be the reaction of the policymakers to that report and what would be the openness to act upon our recommendations in the ongoing negotiations of changes to MiFID and MiFID II Act. We have regrettably no visibility on that. On the bright side, given the high political priority for the simplification and burden reduction, which is more of a personal aspiration, but I would like to believe that that reaction would be known sooner rather than later. And I don't think it will take us too long to understand whether those recommendations found their place in the negotiation process. As soon as that is clear, then that's the moment when we have reasons to start indeed discussing how do we then collectively organize the work on the implementation, especially. I think there was a question in the chat that should participants like to provide written feedback or share suggestions and views in support of the ongoing work and the final report, what would be the deadline? Under control of the project leads next Friday in particular.
If possible, even earlier to finalize a bit our thinking, it would be helpful. The earlier, the better, but yes.
But anything that comes until next Friday, we can still try to reflect in the context of ongoing work. From there onwards, I appreciate that 5th of June seems like a very far away from the beginning of July when we plan to publish the report, but we need to understand there is an internal governance with several approval rounds, and the report actually leaves our desks in the middle of June. Therefore, next Friday, 5th of June is the deadline that if you would like to provide a further contribution, this is still something that we can.
I don't see any more questions being raised. There are still some probably in the chat that we can address in writing. We try to filter at best. So with that, I think we can reach the conclusion part of this session. And we were very efficient, so we took less time than expected. But with very, very important contributions and lively discussion from all of you connected. It's good to see that most of you remain connected until the end. And with that, I thank you very much. But I also wanted to pass the floor to the head of our department, Fabrizio Planta, who will give some closing remarks.
Good afternoon, everyone. I just want to thank you for your participation to the open hearing and your continuous engagement on this important project. We are seeing really for once that we are all working toward a common objective, that is reducing burden, but while maintaining an adequate level of information for the competent authorities. We really see how important is this project. We initiated it, but we receive so much support. I mean, also in the data day, it was so uncontroversial and really we got a lot of praise for initiating this work. So we can only expect that once the recommendation will be out, there will be follow-up because the cost and benefit that you have discussed today will show some concrete numbers and concrete benefits that the reform can bring. And I can reassure that his engagement with you and other stakeholders will continue then in the implementation phase, because we need your support and we need your guidance also on how things can be transformed from theory to practice. But there is an intermediate step that is the one that Olga described, that is the legislative process, which we hope it will initiate sooner rather than later, and hopefully relying on existing processes. But at this stage, we don't have visibility on that. We simply can can share that the support does not come only from you, but it comes from our governance, so our competent authorities are very much backing these initiatives. Other authorities that have been involved through the process also see the benefit of the long-term solution and are very much engaged into that. And certainly all the policy makers that we have engaged with see this initiative as a flagship in terms of burden reduction. So I'm very confident that this project will see its daylight because it will. There is a lot of backing, not only from the industry, that is certainly important, but from the empirical evidence and from the political masters. So I just want to reassure you that we are very confident that we will see the changes appearing, not only the potential low-hanging fruit, but the final outcome that, as we have said, will take some years, and it will take also further engagement with you on the implementation side. But ultimately, it will lead to cost savings that you have discussed today. So with this, I will just close the session, and thank you again for your participation.
Thank you.
Thank you very much.
Thank you very much.